Hello everybody and welcome to this special webinar event. I'm Terry Ryder, founder of hotspotting.com.au, and today our topic is the new depreciation reality, how to ensure your tax return ready. And my special guest today is someone who knows this subject better than anyone in the nation, Peter Folds from Washington Brown. So here's the background. It's tax time and property investors need to be ready. But as Peter has just alluded to as we were chatting a few moments ago, it's a little bit more than that. Given the economic uncertainty, it's never been more important for investors to maximise their deductions to reduce their tax. And at the same time, investment in new homes is soaring around the country on the back of government stimulus. Enhancing the bottom line through depreciation is a key attraction of investing in new property. And in fact, yesterday I hosted a webinar which focused on the benefits of people investing in new properties rather than established ones. And the case studies presented at that webinar showed examples where investment in a new house and land package, for example, was maybe a break-even situation or very slightly positive cash flow until the impact of depreciation benefits was applied. And in those case studies, the application of those depreciation claims transformed properties from being maybe cash flow neutral to being strongly cash flow positive. And that's the kind of profound impact a depreciation report can have for property investors. So to learn more about that and a whole lot more, I'm going to hand over to one of the nation's foremost experts, Peter Folds of Washington Brown. Peter, welcome.
Thank you very much, Terry. Always a pleasure to have a chat with you. Thanks for having me. And hi to everyone joining us online too. Terry, we might have to have a chat about those intros you give after such a detailed description. I'm not sure I can add anything to that actually, which of course is a joke. I have a whole slide deck prepared and a lot of information to share with you and our audience. You're quite right with various government incentives at the moment and the state of things within the COVID-19 environment. There is a big shift. We're certainly noticing that towards buying new property. As I said, a lot of government incentives and benefits to doing that. From a depreciation perspective, whilst this is our bread and butter and our specialisation, we wouldn't advise anyone make their investment purchase decision based on depreciation. It is undeniable that the depreciation benefits are much, much higher on brand new properties. So we'll have a little talk about that. Thought we might cover the basics, Depreciation 101, just to give us all a grounding if anyone out there, still isn't aware of it. And also, of course, to talk about this, the new reality of tax depreciation, which, as I was saying to you before, is not just a conveniently catchy buzz phrase, actually specifically relevant to changes that have happened. So thought I might jump in and share some slides with you.
Okay, by all means do.
Okay. You've seen that all right at your end?
Yes, coming through loud and clear, Peter.
Thank you. All right, so what is property tax depreciation? Now, we've thrown that term around 100 times in the first 3 minutes already. What does that mean? Look, it is a legal tax deduction. It's all to do with the wear and tear of an investment property over time as it ages. I like giving the example of as a plumber might purchase a ute in order for he or she to go out to jobs and earn their taxable income. The government will let them claim a depreciation deduction on that ute or that vehicle. We're lucky in Australia still that we're able to do that on an income generating property. So tax depreciation is the claiming of depreciation of an income producing asset over time. It's based on the construction costs. We're often confused with valuers. A valuer is looking at a property to work out in the current market state and environment what that property is worth. For tax depreciation, we're in accordance with ATO guidelines, we're only concerned with the construction costs, what it costs to build at the time of construction. And as quantity surveyors specialising in tax depreciation, we're the ones recognised by the ATO as having the skills and experience to be able to calculate those tax depreciation deductions. So I guess important to add as well that whilst we buy an investment property majority of the time looking for capital gains. We want that to go up in value over time. The split is that the land appreciates and goes up in value, whereas the building itself, as it gets older, actually declines in value, and depreciation is the ability to claim a tax deduction against that loss of value or aging. Now, why should anyone care? Why should property investors care about this? It's because claiming depreciation reduces your taxable income. So, you know, obvious there, you pay less tax. Claiming depreciation helps you pay less tax. Continue on, there are two components of tax depreciation. So when we're assessing an investment property for our clients, we're looking at two parts of that. One is the plants and equipment. So things like the washing machine, the dishwasher, the ovens, the blinds, the carpets, if I hadn't said that. Whereas the other component, the building allowance, is the structure itself. So the concrete, the bricks, the windows, etc., the roof, the structural component. Yeah, and just finally on that, there are two accepted methods of calculating and claiming tax depreciation that the ATO accepts. And Washington Brown depreciation reports include both of them as standard. They're the diminishing value method, which, as you can see from the slide here, Terry, this method sort of escalates or speeds up the rate of depreciation and how quickly you can claim those deductions, weighting the bigger deductions in the earlier years and then exponentially decreasing. Conversely, the prime cost method spreads that out evenly over the effective life or the eligible time frame that one's able to claim depreciation. At the end of the day, they should both be the same.
Peter, does the taxpayer have a choice? They can choose one or the other when they're doing
Absolutely.
that?
Absolutely, Terry. That's not something we as quantity surveyors can advise or would advise or should advise. You are, when a client of ours gets a report, as I said, they've got access to both of these methods, and they would sit with their accountant or financial planner and look at which method represents the most benefit for them based on their tax position. For most people, it's going to be the diminishing value method. People want to claim maximum deductions as early as possible, but there are certainly some scenarios where you don't want that, or why the other option would be better.
Okay.
This is something when we've been talking about depreciation in the past, we've never really thought to show what the actual depreciation report looks like. And so I thought I'd include just a couple of screen grabs to what the end product looks like. So this depreciation schedule that we're producing is an ATO compliant document that details the maximum amount of depreciation deductions that a property investor can claim each financial year. It is a one-off exercise, so it's not something that needs to be done every year. A comprehensive depreciation report from Washington Brown will span the entire duration of that client's ownership. So nice to know that the fee is tax deductible and a one-off. So the depreciation report itself looks like this. These are some screen grabs from it. Now, not going through all of that, but you can see how technical and detailed it is. What we're doing is itemizing all depreciable assets within the property using the ATO defined depreciation rates and calculating how much depreciation is eligible on that individual item. Now that comes together in a table or two tables within that report. This is that diminishing value method. So you can see here by financial year, shows the total amount claimable that your accountant would use to correctly calculate your tax lodgement. And the other table is the same, but just using the other method of calculation, the prime cost. So I hope that might be interesting for people that haven't seen a depreciation report before. All right, so that's great, Peter. You've explained it really well, I hope. But how does it help? Of what benefit is it? Thought I'd show a quick example here. So without depreciation, if I'm earning $80,000, taxed at 37%, for example, obviously tax at 37% of that 80,000, that's how much I pay in tax. Now, obviously, this is a grossly oversimplified model here, but to highlight the benefit. Now we look at what that looks like if we are claiming depreciation. So we've got now a report from Washington Brown, and in this report, it says that there's $17,000 in deductions in that first financial year. So now we've got our $80,000 taxable income, less the $17,000 in tax deductions, which is now reduces, our taxable income to $63,000. So we're paying 37% of 63,000 instead of 80,000. We're now paying 23,310 in tax. So in summary, by claiming depreciation, we've saved $6,290 in tax. Now, important to put this in context, because often when we're talking with clients and they're not sure whether it's worthwhile to proceed with a report, we'll provide an estimate. Now, if I've said to a client, look, you're going to get $17,000 in deductions, there are often times where the client's fantastic, I'm going to get $17,000 back in my pocket. And it's not the case. It's a deduction off your taxable income. And so the tangible benefit, the cash in your pocket saving, will obviously depend on your tax bracket and the rate you're being taxed at.
I would have thought, Peter, for most people, 6,290 less tax,
yeah,
is something worth doing. That's a substantial sum of money to most people.
Yeah, absolutely. And I mean, that's going to vary. That amount is going to vary heavily depending on the property, the age of the property, the purchase price, when they bought it. So there are many factors in there. But I guess my argument is that even if that saving looks more like $1,000, or worst case scenario, it's looking like $500, surely that tax saving is better, whatever it is, in your pocket, rather than giving it as a tip to the taxation office. I mean, they do a good job, but maybe not good enough to be offering tips, I would have thought. And bear in mind, this example is based on 1 year. If you've purchased a brand new property, your depreciation report shows tax deductions each year for 40 years. And you're still only paying for the report once. All right, so moving along, which properties are eligible? Can everyone claim, every property investor claim depreciation? And the answer is no. Not everyone can, but there are some myths in the industry within certain related industries as well, and I wanted to try and break some of them down. So we all know that new property offer planned purchases, depreciation is the highest on them, the maximum benefit available. It's being able to claim on both of those categories I mentioned before, the plant and equipment and the structure, for the full 40 years, as long as the property is available for rent from settlement. The myths or the uncertainty exists around second-hand properties. Now, needs to be said, clients are eligible to claim tax depreciation deductions on second-hand properties. They absolutely are. Now, on older properties, if the property was built after 87, it's going to be worthwhile proceeding with a report. There are going to be enough deductions occurring yearly for up to 40 years from construction to make it worthwhile purchasing a report and proceeding with that exercise. We know that almost for certain. We'd still want to check that for our clients. For a second-hand property that was built before 1987, but after legislation changes in 2017, we can't claim any deductions on the original structure because it was built before 87. Because of that legislation change, we can no longer claim depreciation on the existing plant and equipment items. So the air conditioner that was in that property when I bought it, the carpet that was in that property when I bought it. So why am I telling you on this slide that you still can claim depreciation? It's because as the new owner or the current owner, you are still eligible to claim deductions on the structural component of any previous owner's renovation. Now, for a property that was built before 87, if it's caught your eye as the investor and you've paid an amount of money to own that, it's likely that it's had some sort of renovation or improvements to that. We typically see improvements to decking areas, awnings, sometimes extensions in terms of levels or another room, certainly on bathrooms and kitchens and laundry areas. Now, all of those typical improvements have a significantly high structural component, which you as the new owner can still claim depreciation deductions on. So we'd always want the opportunity and encourage people to say, well, look, you know, it is an older property, but is there enough deduction available to make it worthwhile proceeding? Costs nothing to ask the question, and we'll happily investigate that for people inquiring. So just to show some figures around that. So for a second-hand house built in 2010, purchased in 2020 for that price, this is the likely deductions available. Now, the diminishing value column is showing as not applicable. It's because we can't claim depreciation on the plants and equipment items. Once again, the air conditioners, ovens, carpets, they're the ones that are affected by the change in calculation method. So diminishing value isn't applicable in this case, but these are the deductions that the new owner would be likely to claim, in this case for another 30 years. So this shows 10 years, but there'd be another 20 years of that same deduction. Now, brand new property, as we've mentioned, and you know, as you talked about with the guys in your webinar yesterday, Terry, they can claim on the structure and the plant and equipment component. Also worth mentioning that if it's a brand new apartment, as opposed to a house, that there are typically common areas and facilities that you as the owner are eligible to claim deductions on too. So we'd be looking at ensuring that you're claiming your portion of those as well. If we compare the figures on a brand new house and land package, for example, purchased for the same amount as in the previous example here. So once again, this was 4,000 in deductions a year, but on a brand new property, you can see the figures are significantly higher. Because we can claim on the plant and equipment component, the figures are much, much higher in the first 5 or 6 years, typically 5 to 8 years. So it's $14,000 in tax depreciation deductions compared to 4,000 on that older property, the 10-year-old property. So it is a huge difference. So now we talked a bit at the start, Terry, you mentioned it about the new reality. What are we talking about when we mention that? Well, previously, before the legislation changes in 2017, if you came to us and said, "Hi Pete, I've just bought an investment property," without me asking how old that property is, you know, when you purchased it, we knew that there were going to be significant depreciation deductions available to you. We knew that it was going to be worthwhile for you to proceed with the report. You know, our industry sort of said that, well, because we need to know what the air conditioner looks like in that premises, how many air conditioners, you know, how many rooms are carpeted, is there an oven, is there a dishwasher? We needed to go to site. You know, that was the very much the industry norm. However, legislation changed and said that, well, people purchasing second-hand property are not eligible to claim depreciation deductions on those items that I've just mentioned. Also then came the COVID restrictions, sort of limiting property assessment and inspections, even where we were sort of legally allowed to or could have conducted inspections. It's important to respect that tenants may not have felt safe, sort of letting people into their apartments because of that, the pandemic. You know, our inspectors may not have felt comfortable with that. So considering all of this, at Washington Brown, we're sort of forced to take a good hard look at this industry norm. And it's some changes certainly in the way that that we now conduct business and what we're doing prior to sort of starting work on a report. We now will look at a property when a client contacts us and look at whether conducting and charging for an inspection actually represents any benefit or additional value to the client. In many cases, we've got access to enough information, more than sufficient information, to be able to produce that fully comprehensive ATO compliant report without needing to conduct that inspection. That's sometimes, as an example of that, Terry, I mean, we've been going for 40 years now. So if you've gone and purchased an apartment in a building that we're already familiar with, that we've been to numerous times before over the years, if you're not eligible to claim on the plants and equipment items within there, and we've got access to sort of photos, strata plan, floor plans, and we've assessed the common areas before, there really is no value or benefit in us charging that amount to include an inspection. It doesn't affect the results for the client. What it means then is we can still proceed with the depreciation report, but typically at a significantly discounted fee from that standard pricing. So we're passing that saving on to our clients. It means the client isn't held up waiting for us all to get vaccines, so it's safe to go out and about in the world again. We can still help them achieve and maximise their tax deductions. That's a big change to how things are done. It's a lot more work on our side, which we're happy to do. It means that we're assessing each property before we're quoting or before we're proceeding with the report to work out, is the client going to benefit from an inspection? Can they provide additional information that'll mean an inspection isn't necessary, or do we already have access to that information?
So the pandemic's it's obviously changed the way you do business. It's created more work for you, but there are benefits for your customers and reduced costs for not needing to do that inspection in every case.
Absolutely, Terry. Look, there are still cases, like we're definitely not saying that no one needs an inspection or that we do not need to inspect properties anymore. There are certainly situations where inspecting the property is necessary. If we're not familiar with the building or the property before and can't get sufficient construction related information or photographs, where it's still in the client's best interest for us to conduct an inspection, and we'll absolutely recommend, suggest and explain that and want to go ahead with it. But yeah, it's certainly been a big change to the status quo.
Okay. All right. Certainly a few questions that have risen in my mind. One of the points you made, and I think it's a point well made, is that a depreciation schedule is something you need to do once. It's a one-off fee and it can last for the duration of the property. But for most people owning a property long-term would at some point make some changes, maybe do some extensions, renovations, replace the oven. When that occurs, what do they need to do? They need to call you back in and reassess?
Terry, that's a fantastic question. That's a really good question. Thank you. As I mentioned before, the depreciation report from Washington Brown is fully comprehensive. So it spans the entire eligible duration that depreciation is able to be claimed for that client. You're right. If the client does a significant renovation or improvement, we may want to produce an amended report. If that's it's sort of a $100,000 renovation, there might be a small amendment charge. It's not a case of needing to spend the entire cost of a new report. There might be a small amendment charge in the future. However, if a client goes on to purchase a new air conditioner, let's say it's 4 years after getting the depreciation report done, we're happy to speak to the client and amend that report at no additional cost.
Okay.
You know, if it's a couple of items within the sort of the first 5-year mark, there's not going to be any charge to amend that report.
Okay.
The other thing worth mentioning is, Terry, you need an accredited quantity surveyor to prepare a report on a property, because many of the individual costs are not known and cannot be known by that purchaser. For example, when someone purchases a second-hand property, they're not aware of how much the bricks cost at the time of construction, or how much the walls cost, for example, or the cabinetry cost. That's our job and what we're accredited as being able to do. In contrast, to use that example of the air conditioner, because the client property owner is going to have a receipt saying, this is the item purchased, this is how much it costs, the client's accountant is also able to use that. Because the cost is known, they're able to calculate the depreciation as well. So there's options available to the client then.
Yeah, that kind of speaks to one of the questions I had in my mind. I mean, I would certainly never, ever even contemplate trying to put together a depreciation report myself. I mean, what hope for an individual? You know, there's lots of people out there want to save money any way they can, doing the report themselves. I mean, I just think it would be incomprehensible. What are your thoughts on that?
Well, being someone who's in the business of selling depreciation reports, I'd have to say, look, the ATO won't accept someone sort of producing, a property investor producing their own depreciation report. It's just not ATO compliant. So that's not permissible anyway.
Okay.
There are other companies in our industry that have different approaches, where it's sort of, they might be a little cheaper than we are, but they offer a sort of a self-assessment criteria. Now, whilst that is technically ATO compliant, my concern or hesitation then is it sort of expects you as the property owner to be an expert in tax depreciation and to be able to list and assess all of the items that you're potentially eligible to claim on. So as I said, yeah, you might be saving $100 or $200 initially in the short term on the cost of the report, and remembering that they're tax deductible dollars as well. The risk is then you're potentially missing out on tens of thousands of dollars in deductions each year for up to 40 years by not having a professional do it as well. So,
yeah. Just looking at it from completely the opposite angle, and probably this is a situation that I get more feedback about, is that some people are put off from going to the trouble of organising a depreciation schedule because they think it's a hassle, going to be a lot of work for them. But I think the reality is it's very, very little work for the customer at all. You do all the work. They just need to tell you that you want it done. They want it done, and off you go and do it.
Yeah, that's exactly right, Terry. I would be very interested to know. I should have kept track on it. You're a man of statistics yourself, so you'll be ashamed of me for not compiling this data. But there is such a large proportion of people that just don't know about depreciation, and that's one thing. It's another thing and it does happen, clients sort of thinking, well, sort of too hard basket, like you've suggested, Terry. It's not. We really are doing the hard work. Are we going to ask for some property details that sometimes may involve a rummage in one's emails? Yes, it's necessary to ensure ATO compliance. But even then, it's things like purchase price or construction costs if you had the property built, settlement date or completion date, details of any additions that you've made. So that air conditioner that you added 6 months after purchasing. There's nothing that's too difficult there, and it's all stuff that most people would have it at the ready.
Okay, and Kevin has commented, and in the chat box, we always rely on the depreciation specialist, and then our accountants do all the work after that at great value. Well, I would agree. I mean, I think it's for a relatively small cost and very little time and effort on behalf of the consumer. You can get this comprehensive report that can be useful to you for the life of your ownership of a property that saves you many thousands of dollars per year, depending on the type of property and the age of the property. So,
and that's very true. A good comment. Thank you, Kevin. I've talked about it from the workload or minimizing the workload on our side of that. But once you get that tax depreciation report, that goes straight to your accountant. We can send it to your accountant on your behalf if you let us know those details. But that's simply a digital copy of a document that you send to your accountant, and he or she then has absolutely everything they need to work out the deductions that you're eligible to claim on, or to factor those deductions in. So it's kind of I guess the term is set and forget. Once you've given us the details we need to be able to prepare the report, we can have the report back to you if no inspection is required, typically sort of between 7 to 10 days. Sometimes a little longer if we have to factor in the inspection. But after that, it's just a matter of paying for the report as the report nears completion and passing that on to your accountant.
Okay. So perhaps we can turn to some of the lots of questions and comments coming in, Peter. Andrew is asking a question I think you may have already answered, but he's saying what tax deductions are available in purchasing existing property. I think you did cover that fairly well.
Sure, but happy to reiterate. Thanks for the question. So purchasing an existing property, the thing about the legislation change that occurred in May of 2017, what they said, the government said, was they are going to put a stop to people being able to claim deductions on the previously used, is the buzzword, plants and equipment items. So for someone purchasing an existing property, that's talking about items, like the blinds, the carpet, the existing oven. So you cannot claim depreciation on those items anymore, purchasing an existing property. As long as that property is built after 87, you are still very much entitled to claim on, which hasn't changed because of that legislation. You can still claim on that structural component that I mentioned, and that spans 40 years from the construction or the build year, the year of construction. So in Andrew's question, you are still eligible to claim yearly deductions for up to 40 years from the construction year on the original structure. I guess a good time to mention that of the two components I mentioned and keep mentioning, the plants and equipment and the structure, over that effective life of the property, depreciable life, the 40-year period, the plant and equipment typically represents maybe 25 to 35% of the total deductions available. So even though you're purchasing an existing property and cannot claim on that component anymore, you're still eligible to benefit by claiming on that larger structural component.
Okay. Amanda's asking an interesting question. If it's an investment used for holiday letting and only short-term rentals, is the fridge included in furniture, bedding, tables, chairs? How does that situation affect the depreciation claims?
Okay, bit more specific. So at a very high level, you're still eligible to claim deductions on the property. You've just got to show that it is, legitimately available for income generating purposes for majority of the vast majority of the year. In terms of the assets within that, as long as they were purchased brand new for the property, and the property hasn't been owner occupied for any duration since settlement or since those items have been purchased, you would be eligible to claim depreciation on those plant and equipment assets, like the fridge, I think she mentioned as an example. And that's not just for the short-term accommodation. That goes for any investment property. If you're purchasing an existing property, you can't claim on the existing or previously used stuff. If you go and buy new blinds, a new air conditioner, a new fridge, new dishwasher, you can absolutely claim depreciation on all of those items.
Yeah. There's a comment from NASA, which is interesting, saying if I knew about depreciation 17 years ago, I would be a multi-millionaire by now. And it's surprising always to find and to read, as I often do, that so many people out there who own investment properties don't even know about depreciation or just neglect to claim it. And I guess you find that constantly, Peter.
Yeah, very much so. It's not something they teach at school, or at least didn't when I was going through school, or perhaps I skipped that day. You know, it's unless you're told about it, or in your property investment journey, you're speaking to professionals or exposing yourself to education, such as the you know what we're doing today, Terry, and what you do on a variety of other topics related to property purchasing. Yeah, you wouldn't be expected to know about it. Yeah, it's a very specific thing, but a very, very beneficial thing. And it still surprises me how many property investors, sometimes who've already built a portfolio of properties, don't know about tax depreciation. So you certainly are not alone in that boat.
Just referring to NASA's comment that if he had known about all those years ago, he felt he would be much wealthier now. I read an article recently, which I kept for this broadcast, an example of a new property worth maybe about $600,000 over 40 years, tax depreciation claimable, almost $300,000 over that time. Does that sound realistic to you? And because if so, those are pretty big numbers.
Yeah, absolutely. I can absolutely vouch for that. They are sometimes higher than that. You know, the bigger the build, the more expensive it was to build, the higher the deductions. But that is very, very likely. And whilst you cannot say that those types of figures are going to be applicable to every property investor out there, Terry, it's a good segue for me to be able to say, again, it costs nothing to check. You know, now more than ever with, I mean, come tax time, nobody wants to leave potential deductions on the table. Maybe now more than ever with the financial hardship that so many Australians have faced due to job losses and whatnot because of the pandemic. It's so vital to make sure that you're claiming, you know, all of the deductions that you're eligible to do. I would really urge people, you know, everyone listening to get in contact. Send me an email with the property address, the year of construction, the purchase price. We're very, very happy to check and see, look, you know, are there deductions available to you? What would they look like? And is it worth going ahead with the depreciation report? We'll absolutely tell you. Once again, it costs nothing to ask.
And I've actually had that experience with an investment property I bought. Well, I actually asked you directly, Peter, whether you thought it was, because it was quite a very old structure, and the answer came back, well, actually, no, in that case, it's actually not worth. I mean, it was an honest answer. You did yourself out of a fee, but you gave an honest answer to the question as to whether it was worth going ahead and getting a depreciation report for a property as old as that.
I couldn't, Terry, have, you know, where it's by no accident, but just because it's deliberate doesn't mean we're not grateful for it. You know, we've got fantastic client reviews. Our Google ratings are very high. Our, you know, Net Promoter Score, for those familiar with it, is you know, is considered world class, which is quite an entitlement and something we're proud of. We've recently won the Investor of the Year award. I couldn't maintain that level of customer service and customer satisfaction if I was in the business of charging clients a fee for a report that represented no value to them. That'd be a very short-term strategy, and having been in operation for 40 years now, where we're sort of not into those short-term solutions. The hope is that for every client we run that assessment for, obviously, you know, a few of them will be worthwhile going ahead, and perhaps those clients go on to purchase other properties in the future that we can assist with. So,
okay, just on that point, you know, just make contact and ask the question. It costs nothing to do that. How do they get in touch? Well, we'll repeat this at the end so that people know how to get in touch with you if they want to follow up. But how do they get in touch with you, Peter?
Yeah. So the best email address, I think, simple one to remember, is info, INFO, @washingtonbrown, all one word, .com.au. And if you just attention it to Peter and mention Hotspotting or this web session, and once again, if you provide your property address, the approximate year of build, construction, and the purchase price, we're very happy to have a look at that. Yeah, for Hotspotting subscribers,
so
no problem.
Simply info@washingtonbrown.com.au, and we'll repeat those contact details at the end so that everyone's very clear. If they want to follow up for any reason, they can do so very easily. Mark's question, we're doing a renovation on an old house, total cost about $30,000. Is it worth getting a depreciation schedule for that value? Also, we're doing a lot of work ourselves, painting and plastering. Can we claim anything for these items?
Fantastic question. Yeah, I wouldn't like to speculate now or generalize on what you'd be looking at in terms of depreciation on a $30,000 renovation, but it will absolutely be worthwhile for that. It depends on the nature of what you've done, on how high those figures are or how long those deductions will span. But what I can say with absolute certainty is you will be missing out on significant deductions if you do not investigate and proceed with the depreciation report. So please get in touch so I can have a look at that. That's a prime example of a situation where in the past we may have, or the industry, operators in the industry would have said, well, yes, it's worthwhile. It's going to cost you $770 because we're going to need to go out and do an inspection. Good opportunity to explain what I was talking about, this new reality, where it's, if an inspection, the inspection component is to look at what is there and to estimate a value on that when that value is not known. Now, in the case of a renovation, you're going to provide me with, or we'd ask for a spreadsheet with details showing what you've put in there so we know what's there. And we have to use the actual costs where they're known. The ATO would find something fishy going on if you've just done a renovation and can't tell me what it costs. Because of that, I've got that information. An inspection represents no benefit to you. Therefore, I wouldn't need to charge for that component.
Okay. Let's see. Becca's asking, are there significant benefits on doing depreciation for a self-managed super fund property? I mean, I can't imagine why it would be any different from any other, but Peter, what's your response to that question?
It's actually a pretty common question and a good one too. Yes, it's no different in the sense that there is depreciation available, you know, versus a property where there is depreciation available purchased under a super fund or an individual. So you are still eligible to claim deductions. The only difference is, and this part occurs after my touch point, so more a matter to speak with your accountant about, but I believe that it's the tax rate that's the only difference there, because I think with a self-managed super fund, it's 15% tax rate that you're capped at. So what I'm saying is that the depreciation deductions are still claimable, but they'll take on a different in-pocket saving value depending on what your tax rate is. And in a self-managed super fund, that tax rate's a bit lower than an individual's.
Okay. Now, Justin's asking a question. I knew someone was going to ask this question. It basically is, it's quite a long question that's been written by Justin, but I think essentially what he's asking is you claim all of these deductions, and then when you sell it, do you have to give some of it back to the taxman?
Yes, some of it back. It's quite a complex topic, but to keep it as relevant and as general, applicable to as many people as possible, the answer is yes. You do have to factor in a portion of what you've claimed back into it. If you've been claiming tax depreciation deductions on the plant and equipment component, these do not need to be paid back as such, to use that terminology. So we don't need to worry about that. Depreciation you've claimed against the structure does need to be factored into your capital gains tax equation, but we need to remember that in Australia, for most people, there's a 50% capital gains tax allowance. So even though we've been claiming deductions on the full structural component, potentially, you know, for 5, 10 years, however long we've owned it for, we only have to sort of factor in or pay back 50% of that, or factor in 50% of that claim back into the capital gains tax equation. So you're still, in my opinion, better off claiming those deductions, benefiting from having bigger cash flow, paying less tax as you go, and then worrying about it in the future, or having to factor in 50% of that back in the future if you do sell, rather than not claiming anything, not benefiting from that as you go, not improving your cash flow as you go, in the event that maybe you'll sell the property in the future.
Yeah. Oh, it's good answer, Peter. It's also another great reason to adhere to the principle of buying good assets and never selling them. I think that's the key for me to accumulation of wealth through property investment. You don't trade assets, you buy good assets and you keep them. Then you never have to face that problem, Justin.
Exactly.
Kevin's asked a series of questions, and here's the first one. It's quite detailed, so I'll have a go. I hope I can make this sensible to you, Peter. So I'm considering doing an entire external repainting of 2 conjoined villas, which we've owned since buying from the builder 17 years ago, as part of an upgrade, which can also include installation of individual solar systems on each to further encourage strong rentals. To date, they have been our best individual investment properties in terms of consistently lower vacancies. I'd like to make it even more attractive in the present environment, given their age. Are there any special risks or advantages to completing this in the same financial year or otherwise? That's quite a complex question. Does it make sense?
There's a lot involved, and Kevin, I would love you to get in contact at your convenience so that we can have a very specific discussion about that question. Certainly welcome the opportunity to do so. But if I sort of extract the point or the general question out of that, you can claim depreciation deductions on those works in the financial year that you're doing them in. So you need to have a think about, as long as the property is available for income generating purposes during that time, you'll be able to claim the depreciation benefit for the year that you started that. I think you mentioned painting, for example. Now, if that's painting of the entire premises, it is considered a capital improvement or structural by classification. So that's going to depreciate at 2.5% for 40 years, over 40 years. And that'll just start whenever you've completed those works. As I said, please get in touch if you've got more specific questions. Happy to discuss that with you further.
Well, yeah, Kevin, in your case, I would urge you to get directly in touch with Peter and have an individual chat, because you've sort of asked 3 questions. They're quite detailed and they're valid and important questions, but probably best if you make contact and have an individual one-on-one discussion about those, because it's quite complex and difficult to deal with adequately in this kind of forum. Now, Ed is asking, is depreciation claimed on materials and labour or materials only? Saying, say I renovate the house and lay carpet, install light fittings and aircon, can I claim depreciation on my own labour?
Aha. Okay, so the answer is no. You cannot claim depreciation on items or aspects that you haven't spent money on, is the crux of it. If you're paying someone to install that carpet, that is a legitimate expense. You have paid for carpet and installation, and so you are eligible to claim deductions on all of that, or both of those components, if you like. Where people are handier than myself and are doing a lot of the work themselves, they're saving a lot of money, I guess, by doing that, not having to pay for labour or installation. But you cannot claim depreciation on your own labour time, if that makes sense, because there's been no financial purchase, no monetary transaction for that component. There is no deduction available for that. Yes, you can claim it on the paint you've purchased when you've done the painting yourself. You can, of course, claim it on the brand new carpet that you're laying down yourself. But in terms of your time, the answer is no.
What about if they engage a professional to do it?
Yeah, it's certainly claimable. That is a legitimate expense that you're able to claim a deduction on.
Okay.
That'd certainly be considered. Also want to mention that when I've had this discussion with people before in the past, you know, on occasion people have taken offense to that. They're like, well, you know, it had to be done. It didn't put itself in, or the house didn't paint itself. Sort of try and put it into context and say, well, you'd rather not claim your 32 cents or 37 cents in the dollar and not have spent the dollar in the first place. The benefit is the cost saving. You didn't have to spend $1 that you're now, I'm telling you, you can't get 37 or 32 cents back on. You're still winning, but no depreciation on that component.
Okay. Now, James is asking, what happens if the previous owner buys new and does diminishing value depreciation and you buy in, say, year 10? Would the prime cost not be as high as a result going forward? Does the ATO track this?
That's a fantastic question. You cannot claim, as I said previously, the diminishing value factors in. That method is allowing for accelerated depreciation of plant and equipment items. So you cannot claim any depreciation deductions on those previously used items, whether the previous owner has been claiming depreciation on them or not. The ATO can't track it. I mean, it just wouldn't be possible for them to do that. They'd have to be tracking not only who owned it beforehand, but whether that was available for income generating purposes or not, whether it was owner occupied, how long it was owner occupied for. So that's not feasible. And that's what those legislation changes were about. They've made it easier for themselves and said, we now don't need to track it. If you're buying an existing property, doesn't matter what happened before, you cannot claim on that component anymore. In terms of the prime cost method, the structural component that you are eligible to claim on is a fixed amount each year. As you saw, that prime cost method, it's the same amount each year. So that's where you, having purchased that 10-year-old property, that's where it comes into play. The prime cost amount would likely be the same or similar once we remove the plant and equipment component from that. But you just pick up from year 10 to year 40. So you've got your 30 years of deductions.
Okay. Now, James is also asking, if you buy midway through the financial year, can you still claim a full year of depreciation, or is it pro rata?
Wonderful question. So a Washington Brown depreciation report will start it, and as is per ATO guidelines, must be started from your specific purchase date, and the date, more specifically, the date it became available for income generating purposes. And that typically means higher deductions for clients in that first year because of certain items which depreciate at 100%. So an immediate depreciation rather than averaging it over a whole year. So it means that even if you purchase the property 9 months into the financial year, there's still enough depreciation deductions in that financial year to make it worthwhile proceeding with the exercise.
Okay. Ahmed is asking the question, can you claim any depreciation on the renovation for an owner-occupied property?
Unfortunately not. Believe me, Ed, I wish you could. That'd open up a whole new market for me. But unfortunately, depreciation deductions are only available for properties that are used for income generating purposes. You have to be drawing your taxable income to be able to be eligible for tax depreciation. And I should mention that's on residential property, on commercial property, on industrial property, the broader category of non-residential property. So yeah, it's as long as it's income generating.
Okay. Now, Kevin asked a series of questions. You dealt with the first one, and I suggested to Kevin he should get in touch because it's quite detailed. But there's one question here which is probably relatively simple to answer on behalf of everybody, and he's asking, with regard to those who never knew about depreciation for several years or forgot about it, and in subsequent years, can you sort of go backdate your claims? Do you know he's driving out there?
Absolutely. And something you want to be driving at too if you're in that situation. My understanding is that that your accountant is able to amend the previous 2 years' tax lodgements. So you can go back 2 years. Because I know I keep mentioning it, our reports are fully comprehensive. They're showing depreciation deductions starting from your settlement date and the date the property became available for income generating purposes. So in your case, if you're saying you bought the property 10 years ago and it was rented and has been rented for the last 10 years, you haven't gotten depreciation, you contact me, I produce a report for you. The report will show depreciation deductions each financial year from that 10 years ago. Your accountant is able to take that report from us, use the figures apportioned to the previous 2 financial years to amend those tax lodgements. So there would be, there's no way of sugarcoating it. You're going to miss out on a lot of depreciation deductions, but there are things you can do to minimise how much you've missed out on, and you can certainly claim back up to 2 years.
Okay. And John is asking, can you depreciate items in the granny flat if it's income producing? And that might be a case where I think he might be referring to a situation when you're living in an owner occupied dwelling, but you've got a granny flat which is rented out. So it's on the same property. Absolutely.
And that's becoming increasingly popular. So we're seeing a lot of that. And the answer is you certainly can. And the same rules apply to that granny flat as it would if it was a sort of a standalone single dwelling on its own property. As long as it was built after 1987, you're able to claim depreciation on the structural component. If it is a brand new build or you've purchased brand new items for that granny flat to attract a tenant for whatever reason, you can claim the depreciation deductions on those too.
So you could have a situation where the people living in an owner-occupied house for 10 years and decide to build a brand new granny flat out the back and make it a lettable proposition, that there'll be substantial depreciation benefits there.
Huge, absolutely huge. And I'm smiling, Terry, because this is becoming now a daily occurrence for our team here. It's that popular a situation, and rightly so, with the some of the entry and exit costs associated with selling a property and purchasing properties. It's becoming a very attractive form of generating an additional income. So off the top of my head, because I assessed one yesterday, it was exactly that case for a suburb, a couple that have been living in their property, pre-87 built house. They've been in there for 20 years. This is on Sydney's northern beaches. They've just gone and built a granny flat. I think it was $166,000 they spent building this beautiful 60 square meter granny flat, 2-bedroom. And obviously it's available for rent from settlement. And I think it was $9,000, assuming a full financial year. The first year was $9,000 in tax depreciation deductions, and those deductions will occur for 40 years.
Okay. All right, well, Peter, I think that's actually a good note to end on. I'm glad we got that question about granny flats in, because as you've just pointed out, it's becoming such a big part of property investment and a big part of your business. It's a good note to wrap on, because we've just passed the hour. And I must say I'm delighted at how much engagement there's been in this webinar, how many people have asked questions. Above average number of questions coming in my experience with these webinars. So clearly it's a subject that's generating a lot of interest out there from property investors. So very happy we've been able to help so many people.
Thank you everyone for participating. Otherwise it would have just been Terry and I sitting here in silence for the last half an hour. So Very, very grateful for your input and questions.
Yeah, and I'd just like to repeat those contact details. I think the most important thing today is for people who've had their interest piqued a little bit by the discussion today and feel that they need to find out a little bit more, take some action. I would urge everyone to make contact with Peter and Washington Brown. And as we previously mentioned, the best way to do that is by email info@washingtonbrown.com.au. And attention, Peter, I think you mentioned.
Please. Yeah. Yeah, and just provide your attention it to me. Just mention that you're after a preliminary assessment or an estimate. Is it worthwhile going ahead with the report? And if you let me know once again, the property address, the approximate year of construction and the purchase price, that's enough for myself or one of our, highly competent, skilled team to be able to look into that for you. And we will give you an honest opinion of whether it is worthwhile or not.
Okay. Well, thank you, Peter Folds from Washington Brown, for a wonderful, informative and interesting presentation. Thanks to all the participants for your questions and comments. It's much appreciated. There's one or two we didn't get to. There were one or two actually where I felt they weren't really questions for this forum. Some of the questions that people typed and really were questions for accountants about the deductibility of other aspects of property investment. But I think we got to answer most of the questions today. So many thanks to everyone, and thanks again, Peter. Let's do it again soon.
Hope so. Look forward to it, Terry. Thanks very much. Thanks, everyone. Be well. Stay safe.
Okay. Thanks, Peter. Bye for now.